know what the biggest mistake is when planning your retirement life? Ignoring taxes? You've been saving for years, your 401k has grown nicely, maybe you have an IRA, but when you retire, 30%, even 40% of this money could go to taxes. Today, we're going to show you how to reduce taxes on your retirement income, which strategies to use to keep more of your money in your pocket. This information is critically important for everyone over 50. Now, we're connecting with David Montgomery. David has been providing retirement planning consulting for over 25 years, and today, he'll be discussing tax strategies with us exclusively.
Hello, I'm David Montgomery. Today I'm going to share with you the most effective ways to reduce your tax burden during retirement, because your biggest expense in retirement isn't just your living costs, it's also taxes. Here's the reality most people don't know. In retirement planning, how you withdraw your money is just as important as saving it, sometimes even more important. Many people only invest in a 401k or traditional IRA. These accounts are great, but remember, when you touch this money during retirement, every dollar you withdraw is subject to ordinary income tax. If you're over 50, here's what we need to do now. Create tax diversification. You should have accounts in 3 different tax categories. These are 401k and traditional IRA. They provide tax advantages now, but you'll pay taxes in retirement. Roth IRA and Roth 401k. You pay taxes now, but are tax exempt in retirement. Completely. This is very powerful. Regular brokerage accounts. You pay capital gains tax, but this rate is generally lower than income tax. Here's where the magic begins. During retirement, you strategically withdraw money from these 3 accounts. You optimize your income every year. You keep your tax brackets under control. If you're over 50 and still working, or just retired, it's the perfect time to do Roth conversions. What is a Roth conversion? You convert money from your traditional IRA to a Roth IRA. Yes, you pay taxes that year, but after that, no taxes ever. We know RS. If you're not yet 73, your MDs haven't started RMD or required minimum distribution. At 73, the IRS tells you you must withdraw money from this account. And this usually pushes your tax brackets up. But in your 60s, maybe you retired early, your income is low. These are the golden years. You do Roth conversions while you're in a low tax bracket. Let me give you an example. John is 62, just retired. He hasn't started Social Security yet. This year, his income is only $40,000. His tax bracket is low. Joan converts $30,000 from his IRA to Roth. Maybe he pays 12% tax. If he withdrew the same money at 73, his tax bracket could be 22% or higher. It's that simple. Use your low-income years. Do Roth conversions. Protect your future from taxes. Here's another trick. Spread Roth conversions over years. Instead of doing one large conversion at once, do a little conversion each year. This keeps your tax brackets under control. For example, converting $20,000 each year for 5 years is much smarter than doing $100,000 in 1 year. You don't experience a tax bracket explosion, you pay less tax, and over time, you can move your entire portfolio to Roth. Your Social Security filing time is a critical part of your tax strategy. Many people don't know this. Social Security income can be taxable. Yes, you heard that right. You paid into the system for years, but this income can be taxed. Here's the formula. They look at your total income. They add half of your Social Security. This becomes combined income. If your combined income is over $25,000 for singles, or $32,000 for married couples, you could pay tax on up to 85% of your Social Security. So what's the strategy? Delay Social Security. If your full retirement age is 67, wait until 70. You get an 8% increase each year. And during this time, you can do Roth conversions in lower tax brackets. Plus, starting late works, like longevity insurance. If you live to 85, you'll receive much more money. You win both in terms of taxes and total income. Balance your income sources. After Social Security starts, withdraw money from Roth IRA. Why? Because Roth withdrawals don't count as income. They don't increase your Social Security taxation. This helps you avoid what we call the tax torpedo. Spouse coordination. For married couples, one spouse can start earlier, the other can wait. This provides tax optimization and longevity insurance. The lower earning spouse can start at 62. The higher earning spouse can wait until 70. When the first spouse dies, the survivor receives the higher payment. HSA, or Health Savings Account, is the secret weapon of retirement planning. Most people think of this only for health expenses. But HSA is actually a super powerful retirement tool. It has triple tax advantages. Contributions provide a tax deduction. If you're over 55 in 2024, you can contribute $8,300 for family plan. Money grows tax-free inside. Stocks, bonds, whatever you want to invest in. Withdrawals for health expenses are tax-free. No tax at all. Now here's the real trick. Pay your health bills out of pocket. Don't touch the age. Let it grow. After age 65, you can withdraw money from HSA for anything you want. You just pay ordinary income tax, just like an IRA. But health expenses are still tax-free. Medicare premiums, long-term care insurance, prescriptions, all can be paid with HSA tax-free. If you have regular investment accounts, stocks, funds, managing capital gains is very important. Good news. Long-term capital gains are taxed at a lower rate than ordinary income, 0%, 15%, or 20%. Here's what to pay attention to. Look at your portfolio at the end of each year. Are there any losing investments? Sell them. You can offset these losses against your gains. You reduce your tax. An important detail. Watch out for the wash sale rule in this strategy. If you buy back the stock you sold within 30 days, the loss doesn't count. So wait 31 days. Or switch to a similar, but not identical investment. In 2024, if married couples have income up to $94,000, long-term capital gains are subject to 0% tax. This is an incredible opportunity. You're retired. Your income is low. You can sell your winning stocks. Buy back the same stock without paying any tax. Thesis Kayet, gain harvesting. Many people don't know this strategy, but when used properly, it raises your portfolio's cost basis over the years. When you make future sales, you pay less tax. Your years before Social Security, before RMD, do gain realization in these years. Rebalance your portfolio. Sabe on taxes. For example, the years between 60 to 70 offer golden opportunities. You control your income. You can manage your tax brackets. If you're over 70, QCD is a great tool. QCD, or Qualified Charitable Distribution. How does it work? You send money directly from your IRA to a charity. Up to $100,000. This money is not included in your taxable income, and it meets your R&D requirements. Why is this powerful? If you use the standard deduction, charitable donations normally don't provide you a tax advantage. But with QCD, your donation effectively provides a tax advantage because it doesn't count as income. Also, doing QCD by keeping your income low can reduce Social Security taxation. It can lower your Medicare premiums. You can avoid IRMAAs if you're charitable. Using QCD makes sense. Federal taxes are important, but state taxes shouldn't be neglected either. Some states don't tax retirement income. States like Florida, Texas, Nevada have no state income tax. Other states don't tax Social Security, but do tax other income. If you're considering moving during retirement, evaluate state taxes. It can provide significant savings. Example, a couple living in New York has $100,000 in retirement income. State tax could be 6 to 7%. If they move to Florida, they can save $6,000 to $7,000. Every Dear, but careful. Cost of living, healthcare, family proximity, all are important. Don't move just for taxes. But taxes should be an important factor in the decision process. Here's an interesting fact. Some states offer retiree-friendly tax policies. Pennsylvania doesn't tax IRA and 401k withdrawals. Illinois doesn't tax retirement income. Mississippi exempts Social Security and retirement income. Every state's rules are different. Research is needed, but the right state choice can save thousands of dollars per year. Some states even offer tax incentives to attract retirees. Medicare starts at age 65. But if you're high income, you might pay something called IRMAA, or Income-Related Monthly Adjustment Amount. Basically, if your income is above certain thresholds, you pay higher premiums for Medicare Part B and Part D. For 2024, if individual income is over $103,000, IRMAA starts. For married couples, $206,000. Here's the problem. IRMAA is calculated based on your income from 2 years prior. So your 2024 IRMAA is based on your 2022 income. Strategy: carefully plan income increases, large IRA withdrawals, Roth conversions, stock sales. These can trigger IRA. Staying just below thresholds can save you thousands of %. An example, income is $102,000. No IRMAA. Income is $104,000. IRMAA starts $800 to $1,000 extra premium per year for just $2,000 more income. That's why, when approaching Medicare income planning is critical. Good news. You can request IRMAA, a reconsideration for life changes, retirement, spouses, death, divorce, income loss. You can apply to Medicare for these. You fill out Form SSA 44. Your RMA can be reduced. Very few people know this, but it can be a life-saving strategy. Passive income during retirement is the key to your financial freedom. But we must be smart tax-wise too. Here are tax-efficient, passive income sources. Dividend income. Qualified dividends are taxed at capital gains rates. If you're in a low tax bracket, 0% or 15%. Ordinary dividends are at income tax rates, so prefer companies that pay qualified dividends. Municipal bonds. Interest income is exempt from federal tax. If you're in a high tax bracket, it can be attractive. But careful. Yields are generally lower. Compare after-tax returns. Real estate income, rental income can provide many deductions. Depreciation, repairs, management expenses. But careful. Passive activity rules are complex. Work with a tax advisor. Roth IRA growth. Not technically passive income, but money growing inside Roth can be withdrawn without ever paying tax. This is tremendous tax savings in the long run. Finally, the most important advice: work with a financial advisor and tax professional. Retirement tax planning is complex. Everyone's situation is different. Income sources, goals, family structure, all different. A professional can create a personalized plan. Tax laws change. Strategies are updated. A professional keeps you informed of these changes. Advisory fees can easily be covered by the taxes you save. In the long run, it's one of the best investments you can make in yourself. Remember, researching on Google is a good start. But everyone's situation is unique. Tax laws are constantly changing. What's valid in 2025 might be different in 2026. As you can see, there are many ways to reduce taxes on your retirement income. Use your accounts like 401k and IRA strategically. Do Roth conversions. Optimize Social Security timing. Use your HSA. Manage capital gains. These strategies can save you tens of thousands, even hundreds of thousands of dollars throughout retirement. The money is yours. Minimize your taxes. Use more of your money for your dreams. Here's what you need to do now. Review your current retirement accounts. Do you have tax diversification? Are you eligible for Roth conversion? If you have low income years, evaluate it. Plan your Social Security strategy. When will you start? Why? Schedule a meeting with a financial advisor or tax professional. Create a personalized plan. You've worked hard for your retirement. As much of this money as possible should stay in your pocket. Take action today. Optimize your tax strategy. Make the best decisions for your financial future.
Thank you for listening to us. If you liked the video, don't forget to hit the like button, subscribe, follow our channel for more videos about retirement planning, investment strategies, and financial tips. I wish you all a happy and tax-efficient retirement. See you in the next video.